Most people believe debt is a problem banks tolerate, something risky customers sometimes need. But modern banking doesn't just allow debt, it depends on it. Without borrowers, the financial system stops expanding. We imagine banks lend existing money, deposits come in, loans go out. But in modern banking, loans create deposits. The money appears when the debt appears. No loan, no new money. Most bank balances don't come from savings. They come from previous loans. When a loan is repaid, the created money disappears. So repayment reduces money in circulation, not just debt. Money is temporarily tied to obligation. When you take a mortgage, the bank doesn't transfer saved cash. It writes numbers into an account. Those numbers become spendable money, which means most money in the economy exists because someone owes it. This is why mortgages dominate modern banking. They create large amounts of money at once and last for decades. Long loans stabilize banks, short loans don't. So the system favors assets people borrow the most for, especially housing. If debt shrinks, money shrinks, businesses receive less revenue, wages slow, spending falls. So economies are built to encourage borrowing, not eliminate it. Raising interest rates doesn't just slow spending, it slows money creation. Lower rates encourage borrowing, which increases money supply. So rate changes influence how much money exists, not just its cost. Banks earn interest over time, but more importantly, lending grows the entire financial system. Growth stabilizes markets, which means policy often supports credit expansion rather than repayment. You're told to escape debt personally, but collectively, the system requires it. Everyone paying everything off at once would cause contraction, so stability comes from managed borrowing. Societies encourage individuals to reduce debt, but rely on groups to maintain it. Personal responsibility conflicts with systemic necessity. This tension is why credit cycles repeat. Debt isn't a flaw in modern economies, it's a fuel source. Not because institutions are malicious, because expansion requires it. A stable economy isn't one without debt. It's one where debt grows predictably. Too fast creates bubbles. Too slow creates stagnation. Balance is maintained by adjusting borrowing, not eliminating it. The goal was never a debt-free system. The goal was a stable, expanding one. And expansion needs balances that are never fully settled. Debt doesn't only finance the economy, it sustains it. Imagine every household and company suddenly paid off all loans. Balance sheets would look healthier, but money created through borrowing would disappear. Spending would drop immediately. Businesses would lose revenue, not because demand vanished, because purchasing power vanished. So eliminating debt doesn't stabilize the system, it shrinks it. Economic stability isn't the absence of obligations, it's predictable obligations. Payments scheduled over long periods allow planning. Sudden settlement removes flow. So systems prefer continuity over closure. Money functions because people trust it will circulate tomorrow. Loans create that continuity. Each payment implies a future payment, and that expectation keeps transactions moving. This is why personal finance advice sounds different from economic policy. Individuals reduce risk by reducing debt. Economies reduce risk by maintaining it. Both are logical. They just operate at different scales. The financial system doesn't need everyone indebted forever. It needs enough balances outstanding to keep money moving. Debt is not only a burden carried by borrowers, it's also the structure holding circulation together. And once you see that, modern finance stops looking temporary. It looks designed to continue.